Hello guys and welcome to the second episode of this series. So the name of the book I want to review with you today is Charles Munger, The Complete Investor. So who is Charles Thomas Munger? Well, Charles Munger is a billionaire American businessman. He's an investor and is the vice chairman of Berkshire Hathaway, which is a big conglomerate, a holding company controlled by Warren Buffett. Buffett has described Munger as his closest partner and his right-hand man in business. So Munger is the chairman of the Daily Journal Corporation and the director of Costco Wholesale Company. So Charlie Munger wrote a book called The Complete Investor to discuss what he and Warren Buffett do to remain successful throughout the years while picking their investments. So how they do it. It is very clear that this book is not for the typical index investor, but it's for someone that wants to get involved and really wants to spend more than a few hours per week in investing. So the book describes therefore the framework and the behavior an investor should have when investing. Munger is a strong believer in checklists and he uses them constantly to try to avoid making mistakes. He then uses something called the Graham value investing. So the point of the book is in fact to teach us the rules for better decision making when investing in stocks, to reduce to the minimum the number of mistakes we can do in an investment by using these Graham value investing. This is made for investing in the long term, and Munger and Buffett indicate that you must continue also to develop yourself and continue reading, because if you're looking to invest in the stock market, you really must like also the process of doing so. So, Munger indicates there are four fundamentals in value investing, and they are: number one, trade the stocks as a proportional piece of the business. Number two, buy at a significant discount to intrinsic value. Number three, make the bipolarity of the market serve you. And number four, be rational, objective, and dispassionate when investing. So again, Munger and Buffett use something called the Graham value investing system, which is meant to render decision when investing very simple, uncomplicated, in order to avoid any kind of mistakes or any kind of confusion, rendering the investment accessible. So venture capital and private equity are a very different approaches because they are complex and they cannot be predicted precisely with enough accuracy to reduce the risk. So value investing instead allows you to remove the risk, but finding the right investment may really take a lot more time, since we will be discarding all the companies that we cannot value due to the complexity, and we will move on to the next one. So this technique is meant to shine in flat or bear markets and underperform in bull ones. So he is not trying to invest intelligently, but is trying to invest not stupidly by avoiding as many mistakes as possible, since he realized that for every transaction that is made in the market, there is a winner and a loser, even if the market had a return that was neutral for both parties, there would be a loss for the investors overall, because the result of the transaction would be always the loss plus the winnings minus the transaction costs, which are the brokerage fees. So since the result overall is negative, this is a form of gambling for most, because the sum doesn't equal to a positive value, but it's a negative one. So while some people think they're investing, they're actually gambling. So this technique relies on the market folly, as if the market were perfectly balanced, there wouldn't be an opportunity for making money. But since every now and then the investors act like fools, we are allowed to take advantage of these opportunities instead of investing in the short-term predictions, which increase the amount of risk while diminishing also the returns, given the transaction fees continue to add up the more we trade. So the problem of traders is that everyone thinks that they are able to predict and outperform the market, but while statistically only 10% of traders are successful, even if you make profits a few times now, over long periods of time, it's almost certain that you will not profit compared to what the remaining 10% of the people are doing. So understanding the market is made also more difficult by money managers and people that generate their income by creating psychological and emotional distress in creating dysfunctions in the market by complicating things for the average investors. So they make it more likely that you will leave your money with them to be managed. So since you need to work a lot to be a passive investor, he indicated that if you are an emotional type and you're likely to be overwhelmed by your emotion, you should join the market instead of trying to beat it by investing in some ETFs or some index funds, for example, and not try the Graham value investing technique. So let's go over the 4 principles we explained earlier one by one. Number 1, we said it's treat a share like a portion of the business. So if you do not understand the actual business of the company, you cannot fully understand its valuation. You must treat it like a private company you were trying to buy in full cash. So you must consider its operations, you must start asking questions from the bottoms up about the products, the cash flow, the competition, the past returns, the current income of the company, without resorting to future predictions. So leave outside the technical side of investing, like the charts and the signals. You must focus only on the safety of the principal and adequate return. Number 2, you have to buy at a significant discount to intrinsic value for a safety margin. So there must be a difference between the intrinsic value of the company and the current market price to provide a large margin of safety net so that we can be profitable even if a mistake is made and we reduce the risk of losing money, the principal, when we're buying. So intrinsic value is the present value for future cash flow. And we can calculate this margin of safety so that we do not require to make any predictions, since we are not looking for short-term investments. So if you take the stock price and you multiply it by the number of shares, and you get 1/3 or less of the sellout value, then you have an edge. You have a competitive advantage. However, since finding stocks that satisfy this criteria is very uncommon, you are required to have lots of patience when practicing this technique. Number 3, you have to make Mr. Market your servant. Munger likes to describe the market as a maniac depressive dude that comes by every day, and he will try to sell you stuff for less when he's depressed and will try to sell you stuff for more when than it's worth when he's enthusiastic. So Mr. Market emotional problems arise because he's composed of many people who on short term try to vote to establish the price of an asset based on their emotion and the prediction of what the prediction of other people will be. So if the market is depressed, a market short view on the price can be ignored if the fundamentals of the business remain intact, since the price will correct itself over time. So we do not try to predict when there will be a wiggle in the market, but we wait for it to happen. Number 4, we have to be rational, objective, and dispassionate. This is the best antidote to stupid psychological and emotional errors. It is something very hard to do, and you have to work very long and every day to achieve this. And this is also the hardest thing to do for an investor, meaning keeping your cool. The objective is to try to avoid most of the mistakes and keep things simple while doing so. Then Munger uses something that he calls worldly wisdom, which basically is each person's global knowledge. So basically, if you're a hammer and you think like a hammer, you will see the world's problems as nails and you will try to hit them all in their head. But you cannot fit all of these in a single model of wisdom. So you have to adopt new approaches on all possible disciplines available. So you have to learn more about science, information technology, or mathematics, engineering, philosophy, or biology, and so on. Putting all of this together brings a value that is always greater than the sum of all of its components, since learning one model can improve all the other ones. So to get interested and enjoy learning all these things produces a positive net value. So all this should be done to enhance your decision-making capabilities. And great books can help you to learn that. Munger indicates that it's better to know a bit about everything than to know everything about very little. You can never completely remove your mistakes and errors, but the best thing you can do is reduce the frequency and hopefully the magnitude as much as you can. When making decisions, you also have to start asking the smart questions. You have to use models that can help you reveal the mistakes you're making, and you have to rub your nose on those mistakes you do to learn from them. One of the best ways to avoid mistakes is to own businesses that are very simple to understand given your knowledge. Where you have no knowledge, it will be very hard for you to understand what is happening and why an issue is persisting. So there will be a lot of fraud and there will be a lot of mistakes involved. You must know where the issue originated from. And if you cannot figure that out, then the business is too complicated for you and you should skip and go to the next one. Munger indicates that there are heuristics that tend to be a leading cause of mistakes. So major causes of these heuristic mistakes are the following. Number one, the misalignment of incentives that can lead to a conflict of interest within the company. Like a money manager that does, for example, not have his money on the line, but places order against you to cover his positions. Basically, a proper responsibility system in investing is one where the manager of your money suffers and benefits together with the client. Number two, deliberately self-destructing to protect what is loved. Like when people tend to deny the faults of who they like or who they love. This might be good in society, but it can be bad in businesses and investing. So be careful to loan money to relatives, for example. This is a strategy that was implemented in the Tupperware parties, if you remember, where people you liked hosted parties, like events, to try to sell you something, as you are more likely to buy from people that you like and admire. But when this comes to money, you do not have to be afraid to find people that tend to disagree with you. Number three, life is too short to do business with people you do not like or to invest in unethical businesses. So you also shouldn't pass judgment on a company or a person based on irrational associations that other people gave you. Be also aware that people will tend to manipulate others into making decisions by using pain and hate associations. Number four, we have a doubt avoidance tendency. This is because the brain can substantially reduce the load of information it is processing if it simply rejects doubts. And you use your own experiences to make fast decisions and associations. Once again, this might be good for getting out of some situations, but in investing, this primitive tendency can lead to disregarding the usage of your analytical system, which is your slow and methodical approach, and this can cause problem and lead to overconfidence. Number five, inconsistency avoidance tendency, which is when the brain preserves programming space by being reluctant to change, especially when you hear information that you disagree with and you go against your belief, or when it took you a lot of errors and a lot of trials before reaching a conclusion, and the change would be really unpleasant for you to take. Number six, the need for curiosity and the education, as when you get interested, it is more likely that you can recognize opportunity when you see them. Betting big when the odds are extremely favorable as a result of the prudence and the patience we use to scout this new opportunity. So sometimes too much curiosity can also lead the business to engage in too many activities by constantly pivoting the business into oblivion. Number seven is fairness tendency, because we tend to expect people to be fair with us, but many people react irrationally when presented with a situation that feels unfair to them, creating errors, mistakes. Number eight is the tendency to jealousy. When we were conditioned throughout our evolution to fight and hunt, to be the leaders of a pack and get all the goods, since we evolved, we can no longer challenge others for possessions. And since we cannot obtain the things that we crave by legal means, naturally we create resentment, envy, and jealousy. So the idea of caring if someone makes more money faster than you is a deadly trap, and it will make the process of making money just not enjoyable. Envy was a sentiment created from a world of scarcity. But since now there is less scarcity and we live in a world of abundance, people become unhappy rather than motivated. So envy must be avoided at all costs. Number 9, we have strong drives to reciprocate positive and negative gifts, going even beyond the rational to extinguish these debts. You may fantasize over how this can lead to people taking advantage of you or in some scenarios. Number 10, because of the influence from the mere association tendency, we make wrong decisions based on pure positive and negative associations that we have. For example, we will listen to an influencer or a paid actor that recommends a product or a service, even if these people have nothing to do with the industry they are proposing. Number 11 is pain avoidance and psychological denial. Is when you distort the reality until it becomes acceptable for you and no longer painful or dubious to avoid the big amounts of stress. Everyone tends to do this with some part of their reality until it is less painful. So people tend to spend none of their time at looking at what they did wrong because they do not want to know and they prefer to deny reality. This is how Bernie Madoff's Ponzi scheme made everyone, even the authorities that were investigating him, reluctant to the idea that his fantastic return that they were seeing were all a scam. So the less you know about the investment, the worse it gets. Number 12 is excessive self-regard tendency, which indicates that we distrust other systems and we trust only those we work a lot on. Every investor, indeed, thinks of himself above the average despite the evidence proving the very opposite. So number 13, over-optimism and over-pessimism tendencies are what make Mr. Market bipolar. You must stay rational to take advantage of Mr. Market behavior. We are usually over-optimistic about the prices and the time we are required for our project and the fact that the problems will not arise when we know very well they will. Number 14 is the deprival reaction tendency that shows that we do not react the same way about wins and losses. The fear of losses can make us do really irrational decisions when there is a potential for a gain. People were in fact so afraid after the 2007 crisis that they completely missed the subsequent rally in the market. And this is also why people try to bet and lose in a casino. They will try to bet even bigger to recoup their losses because of the fear of leaving the place with a loss in their hand. Number 15 is social proof tendencies. They happen when you think of other people know something that you do not, and you blatantly follow them because of the social proof factor and the fear of missing out. So social proof happens because we lack information and a limited time, and it is a cause of financial bubbles. Madoff used this to recruit new investors by letting them know that smart money investors were already investing with him, so new people would not simply question him anymore. People tend to follow famous people in investing even when these people are not famous for their investment skills. Number 16 is the contrast tendency. That happens because the brain cannot use exact units of measurement to measure some things. So it will rely on the interpretation to make the decision. A very bad deal placed next to a less than decent one will make the latter seem like a very good investment, even if both prices are very inflated. So this will be used, for example, by real estate agents that will show you a bad inflated property first to taint the idea of the average home value in the area. One good way to avoid this is to make a lot of comparisons on your own and to choose only the best investments across all investment area anywhere. Number 17 is the stress influence tendency, which happens when people are under a lot of stress and can be led to make hasty and lousy decisions. Munger suggests never to be pressured into making an important decision and to try to never make decisions when under pressure. Number 20 is drug misuse tendency. While some people are more susceptible than others, addiction can happen to anyone, and the degradation is too light and slow for it to be felt until it is too strong to be stopped. Addictions, he adds, are one of the leading causes of disasters and failures in life. So he asks this question: why play dice with something that can ruin your life like that. Avoid everything with a large downside and a small upside. Number 21, keep your body and your mind active, and you can remain sharp as you age, and you do not have to be passive about health. Number 22, authority misinfluence tendency. People tend to follow authoritative figures, especially when facing a lot of risk or insecurities, looking for answers outside of them to reduce their insecurities on the inside. So titles, experience, education, the cars even, the clothes that we're wearing, and wealth can all convey authority. So someone becomes more believable only because they have some of these things. You have to be careful because some people will take advantage of that. Number 23, spending a lot of time on meaningless activities is no good. You should avoid people that have confident answers about everything when they really have no knowledge in that industry. So avoid things that do not make much sense. The hardest meaningless activities to spot are the ones you tell yourself aren't. Number 24, reason respecting tendency is the tendency to increase the compliance when other people give you a reason, even if it is meaningless or incorrect, just because the human brain naturally validates a reason as a value. Now, people tend to buy stocks because of meaningless patterns on a chart to convince themselves that it is the right time to buy, for example. Number 25, the sum of multiple factors cannot be predicted accurately. So when someone tries to sell you on the idea that they know everything because they understood all the variables that are involved, they're selling you a lie. Now, Charlie Munger identifies all the good values an investor should instead have. So attributes that you have to strive for each and every day. Number 1 is the patience with aggressiveness to strike at the right time. So predicting the time to strike is impossible. Therefore, we must wait patiently, like playing poker, by waiting only for the right hand and playing only when you have the highest chance of success. Number 2 is the discipline of reading a lot and getting ready and not investing foolishly just to remain active. There are penalties to being hyperactive, which are the commissions and the taxes on the brokerage fees. So you do not have to succumb to your urges. You need to be diligent and keep an asset when it's below average and sell it when everyone thinks it will continue to rise in value. Number 3, you have to be calm, but you also have to be courageous and decisive. You must take the ups and the downs and deviate from the common view of the crowd and buy even when under pressure. If you cannot, then Graham value investing is not a system that is for you. The best times for you will be the worst for the rest of the market. So it takes a lot of courage, but provides us the greatest profits. Number 4, reasonably intelligent but not misled by it. Smart people are not exempt from making mistakes, and you need to understand why mistakes happen. So the smarter you think you are, the higher the chances you think you can predict something that cannot be predicted. A high IQ outside of his field of competence is also an easy mark and may lead to overconfidence. Number 5 is honesty, as doing the right thing always pays off, and people will trust you more, improving the efficiency and the returns of the company. Number 6 is confidence and non-ideological. By being aware of your limitation and keeping your decision inside your circle of competence. So avoid things that are too hard and be humble to look for ways to disprove or what you or others may assert. Number 7 is long-term orientation with a pain today and gain tomorrow activities. Number 8 is being passionate, as you tend to work harder to learn more and be more resourceful for things that you're passionate about, giving an informational edge over these passionate individuals. So if you try to play the game of investing as a dispassionate against someone that has a passion in that thing, you are lowering your chances of success. So you're not passionate about things you do not understand. Number 9, you should be studious by developing in a lifelong learner, striving to become wiser every day. Number 10, you have to be collegial, so having conversation with colleagues, someone trusted that you can talk to and run by ideas by. Number 11, you have to have a sound temperament to keep the raw emotions at bay and respond well to events that life throws at you. Independent thinking, emotional stability, and keen understanding of the human and institutional behavior is vital for this. Do not succumb to greed and fears. Sometimes getting the help of code and machines can actually help with the emotions to keep them out of the equation while making some of the decisions. So keep a written record of your decision and investments to evaluate your temperament and decide whether the Graham value investing is for you. Number 12 is to be frugal, so you do not overspend your income but make the best use of the money and time you have. And number 13 is to be risk averse, meaning to permanent loss of capital and inadequate returns, because you cannot measure volatility as some people actually claim they can. Volatility is only part of the equation and can be quantified, but risk cannot. Risk comes from not knowing what you are doing. So we pass next to the 7 values of the Graham investing system. Number 1 is determining the appropriate intrinsic value of a business. The intrinsic value is the discounted value of cash that can be taken out of a business during its remaining life. So not all of them can be calculated, and if you cannot calculate, you have to move the company in the too hard pile, which is basically the pile of companies that you will not take into consideration. And you also shouldn't care for a precise calculation because of the margin of safety. So you want to be precise, but you shouldn't care about preciseness. The intrinsic value is a quick calculation to determine how much you would be willing to pay for the business outright. Munger will not touch businesses where all the cash is reinvested in the business and the profits are all in the machinery, for example. So Munger and Buffett look at the owner's earnings, which can be calculated as net income plus the depreciation plus the depletion plus the amortization minus the capital expenditures and the additional working capital. This formula looks at the return on equity, meaning the money you invest, considering the expenditure of the company. So it is one of many formulas that they use, but it should be considered only when $1 invested in the company can generate more than $1 of long-term market value or growth. Could actually hurt the investment. Number 2 is determining the appropriate margin of safety. And this is also an imprecise calculation, but which has to be simple and overpoweringly positive. Do not rely on an investment by its second or third computational digit. It has to be a good deal way beyond that. This does not ensure that buying a quality company is safe. The price you pay for the company always matters. Also, it does not mean that if a company's valuation is beat down, it is safe to bet on it. So if you take the price of the shares and multiply it by the number of shares of a solid business, the result should be 1/3 or less of the sellout value. In that case, you would have a good margin of safety. Number 3 is determine the scope of the investor circle of competence. So we must deal only with the things we are capable of understanding. There is no point in being competitive in a game where you start with a disadvantage. To understand how a business grows, start by studying how businesses decline and die. A competence without defined borders cannot be defined a competence, and do not confuse familiarity with competence. Avoid to be dissuaded by stories and remain within your competence boundaries. Number 4, determine how much of each security to buy. Munger criticizes consultants because they don't put themselves on the line but ask for fees and do it with your money only. He also doesn't believe in diversification. It is not the right approach for him because you should concentrate your investment in what you concentrated your time finding and researching. Because it is hard to find good investments, you should focus on those and invest largely without indexing your investment. Diversification is a protection against not knowing what you're doing. Number 5, determine when to sell a security. You want to buy a few companies and sit on your ass for a very long time until you approach the calculated intrinsic value. So you do not want to keep jumping trains often because of the fees that are involved with trading. The companies you choose should have 1 in 2 chance of winning, and their payout should be 3 to 1. So you pay less to brokers the less trades you do. Some choose to wait many years to take advantage of the compounding effect too. Number 6, you have to determine how much to bet when you find a mispriced asset. You have to fold early when the odds are against you and back it heavily when you have a large edge, because it doesn't happen often. It is a bad idea to buy and sell stocks just to stay busy. When you are in doubt, you should not invest if the decision is a very close one, or if there is a big downside and a small upside. You have to buy when the price is lower because it reduces the risk. Number 7, you have to determine if the quality of a business should be considered. Some companies hold the power of increasing the price without resulting in a consistent drop in sales. A quality company can therefore implement for large periods, large incremental capital at very high rates of return. So it's calculated in ROI, return of investment. A business with superior quality at a fair price can still be considered a bargain. Not considering these businesses is very limiting because the cigar butt companies, like Munger likes to call them, are very few. Number 8, determine what business to own. You must find companies with competitive advantage, so a huge discount on the replacement cost, that are also very hard to replace or to compete with. Competition can kill companies running on very small margins. The fundamental aspect of a business are the management and how to use the capital. So what often Munger and Buffett look in a company's team before investing are these things. The capital allocation skills, which is when the company must maximize the shareholder returns by taking the cash and deploying it in the best opportunity to avoid also some institutional imperatives, such as institutions will resist in any change to its direction. This happened to be one of the leading causes of company going to die, because for example in the internet bubble a lot of companies decided to stay in the direction and do not convert in a website of online companies, and they ended up dying, getting crushed by the competition. Number 2 is as work expands, corporate project and acquisition will materialize to soak up all the funds. See, any business craving of the leader will be supported by strategic studies and report created by his troops. And lastly, the behavior of peer companies will be mindlessly imitated. When management doesn't know where to allocate the funds, it will start to turn to its staff and consultants that will even accentuate the problem instead of resolving it. So a company should avoid these 4 institutional imperatives. The compensation system that creates alignment with shareholders needs to be put in place in the company for them to decide that it is a good investment. You should ensure that everyone working at the management owns a share of said companies to ensure that their best interests are aligned with the company. So the compensation philosophy is listed actually online in full on the Berkshire Hathaway website, and it is called the Owner's Manual, and I will add a link in the description for you to have a look at. Then, there has to be a safety widening skill, meaning a big margin. And the management, you need a manager that can work with the company when it's profiting and also when it's struggling. Sometimes there is nothing the management can do if the business is lousy, even if it's run by the best management. So you should only look for solid companies that do not depend on the management. The only job of the executive should be to widen by any means what they call the moat, which is the competitive advantage, the margin, meaning that you want someone managing with an owner's attitude that cares more about the business itself than the compensation he receives. and they all must have skin in the game. Munger also works to replace the bureaucracy with trust in his companies. Then Munger loves also to find management already in place that is very high in integrity. It is important because it takes fewer resources to ensure the honesty and the compliance in the company, which in effect turns in efficiency. So there must be a zero tolerance policy for lack of integrity. The reputation and integrity of the company are your most valuable asset, but they can be lost also really quick. So you cannot work with dishonest people in your midst. And Munger has no desire in replacing the existing management and train new executives, but they like to buy companies that can run and survive even without good management. Then he accounts for the fact that there are very rare occurrences of managers that should be followed even in mediocre businesses, but he says it is very unlikely to happen on average. So he recommends to always bet on the momentum of the company and not on the brilliance of the manager. Munger and Buffett rely on something called the Berkshire math. To make an intrinsic value calculation, Berkshire takes long-term 30-year US Treasury rates as the discount rate. So they're able to compare all the companies on a scale to choose the most attractive between them all. Munger uses an opportunity cost calculation by considering what all of the alternatives are for the same amount of capital, measuring against it the alternatives. So he will concentrate his focus in companies he understands, and they will have an almost certainty of continuing the current earnings in the future. So rather than adjusting the discount rate to account for the risk, this approach uses a risk-free rate to compare the alternatives by looking at conservatively determined fundamentals and a stable business history. So he will not buy a business without at least a 25% discount to value. The risk is not in the volatility, but the possibility of suffering a loss. So the steps for making this calculation are the following. He will calculate the past and the current owner's earning. He will add a reasonable and very conservative owner's earning growth for the future. And number three, he will discount it by using the 30-year US Treasury rate. So the focus here is the return on equity and not the earnings per each share. Munger also brings us some ways to determine whether a company has a competitive advantage. He indicates these 5 steps to doing so. Number 1, a company has a competitive advantage when the costs fall the more a company or product or service is produced. So chain stores are a good example of that because they buy large stocks at big discounts. So the more they buy, the higher the discount is. And you can also pay high professionals to handle the transactions. Number 2, when a product becomes more valuable, the more people use it, you have a competitive advantage. Number 3, you will have competitive advantage when it is an irreplaceable brand. Brand is immediately recognizable and they can create an image in the buyer's head when you think of it. So people expect from a brand a certain level of quality and a certain level of service. And a brand cannot be challenged or destroyed by others, but it can only be destroyed by itself. A competitor cannot replicate or reduce the competitive advantage of a brand even if they have a large checkbook, a lot of money. Number 4 is regulation, as some companies have such a strong competence that they are entrenched in the regulation. A company has a very strong competitive advantage if it has a patent or intellectual property. So companies that are granted a patent, a trademark, or other types of intellectual property from the government have a monopoly because they remove the ease of entry in the marketplace for new companies, and also they can threaten litigation for newcomers. So why does Berkshire Hathaway have a competitive advantage in this case? They invest in so many companies. How can they keep the competitive advantage? Munger gives us 7 reasons why. The number 1 is because it's tax efficient, because they can reinvest the profits on other things within the company by reallocating the funds to avoid paying taxes, which can compound on a yearly profits, given that indices do not pay taxes. Number 2 is that it has a low overhead. So they operate with deserved trust and very low bureaucracy. The managers also eat their own cooking and they are not required supervision, so they eliminate layers of controls that are required and they are very efficient because of that. Also a top buyer, and they let owners still run the company when they buy it. So they are interested in letting the company stay as it is and continue operation without changing it too much. So they are preferred buyers for the sellers and they get attractive prices because of their reputation. Private equity firms tend to overhaul companies and because they want to flip them a few years later. Number 4, they have permanent capital that lets them outperform other investors. This happens because it takes very long for them to find the right businesses where to invest. Number 5, Berkshire outperforms the bear markets. They focus on not losing the money. That they benefit also from the float because their main income is from insurance, and their insurance brings so much premium cash in before there is ever any claim collections that go out. High quality shareholders is also another big advantage. They think in long term about investing and they ensure the cash flow will continue and that the competitive advantage remains and it will be widened in the future. Since the competitive advantage can fade over time, they ask in advance why the results are occurring now in this way and what could make them stop occurring in the future. So if you have data that supports your competitive advantage, it can be kept for more than 5 years. You have a bit of certainty when you're investing. And basically this is the end of the book. It is a very in-depth look at the operational rules of the conglomerate of Berkshire Hathaway. I really like how Charles describes how to focus on the things that you know, because there is always a good approach to investing. And it is also much more focused on the security on not losing money, which is much different from any other investing book I've read so far, which focuses mainly on diversification, for example, and nothing more. But that's just a tool for saving your money in case you do not know what you're investing in. I think that if you really want to learn, you have to actually learn from the best. And I think that Charles Munger and Warren Buffett, they are millionaires investors, actually billionaire investors, and they are definitely the best investors in stocks that are out there. If you are looking to take advantage of investing in this game seriously, but without shortcuts, and by ensuring that your capital is safe, I would really recommend this book to you, which is really similar actually to the New Buffettology, which delved even a bit more in the calculations and the approaches to determine a company's competitive advantage. So if you are interested in that, I would suggest you take them both. Nevertheless, this is a very solid book. It's not too demanding. And again, it's not very recommended for index investors. The rating I give it, it's an 8 out of 10 because it's not for everyone, but I will link the book in the bio. So if you like more books on finance with this character, you can pick up also my book on finance. It's called Money You Can Trust, and you can find it on Amazon. And I will leave also a link in the description for that. And I will see you guys on the next video.